Let's talk about PayPal Pay in 4 because this is one of the rare financial tools where there actually isn't a hidden catch, but most people still don't fully understand how it works. In this video, I'm going to break down what PayPal Pay in 4 really is, how PayPal decides who gets access, and a few things that can quietly increase or limit when it shows up for you, so you're not guessing the next time you see it at checkout. First, let's clear up a big misconception. PayPal in 4 is not a traditional loan and it's not a credit card. It's a buy now, pay later option that lets you split a purchase into 4 equal payments spread out over 6 weeks. Here's the key part most people don't realize. PayPal pays the merchant in full up front. The seller gets their money immediately, and then PayPal lets you repay the balance over time. So from the store's perspective, it's a normal purchase. From your perspective, it's structured flexibility. This is where PayPal Pay in 4 really stands out. There's typically no interest, no hidden fees, and no surprise charges as long as your payments go through as scheduled. Your purchase gets split into 4 equal payments, and those payments are automatically scheduled, usually every 2 weeks. So when people ask, what's the catch? The honest answer is, there really isn't one. The trade-off is that PayPal is very selective and data-driven about when and who they offer this to. This is another big question. Using PayPal Pay in 4 does not affect your credit score. There's no hard credit check and your payments aren't reported to the credit bureaus like a traditional loan or credit card. And that's why this option feels so low risk to a lot of people, because you get the flexibility without the long-term credit consequences. That said, PayPal is still tracking everything internally, and they just keep that data inside their system instead of sending it out to the credit bureaus. If you've ever wondered why Pay in 4 shows up for one purchase but not another, or why your friend has it and you don't, it's not random. PayPal looks at things like your account history, how often you use PayPal, whether past payments went smoothly, and how stable your activity looks over time. They're not judging a single transaction, they're looking at patterns. Another thing people don't realize, PayPal Pay in 4 isn't guaranteed to appear on every purchase. Some merchants don't support it. Some purchases types fall outside of PayPal's risk guidelines, and sometimes PayPal just needs more recent account activity before offering it again. And that's why you might see it available one week, disappear the next, and then show up again later. When used correctly, PayPal Pay in 4 can be really helpful. It works best for breaking up large purchases, smoothing short-term cash flow, avoiding interest when you don't need long-term financing, but it's not meant to replace budgeting or be used constantly. The value is flexibility, not stretching yourself thin. Now, if PayPal Pay in 4 isn't showing up for you, or it doesn't work for the type of purchase you're trying to make, that doesn't mean you're stuck. Pay in 4 is great when it's available, but it's limited to certain merchants, purchase amounts, and situations. In cases like that, it can help to see what you qualify for across multiple options at once instead of guessing or applying everywhere one by one. I've linked a tool in the description that does exactly that. It checks multiple options in one place and routes you based on what actually fits your profile. It's meant as a backup, not a replacement for Pay in 4. But it can be useful when PayPal isn't an option. PayPal Pay in 4 works because it's simple, transparent, and low pressure as long as you use it responsibly. Understand how it works, don't treat it like free money, and always make sure the payments fit comfortably into your budget. If this breakdown helped you, hit the like button, subscribe for more straightforward explanations like this, and I'll see you in the next video.